A novice investor often loses money in the stock market due to a combination of inexperience, emotional decision-making, and lack of preparation. Below is an in-depth look at common reasons why beginners face losses in the stock market. 1. Lack of research and understanding. Many novice investors jump into the stock market without understanding how it works. They might follow tips blindly, relying on unverified stock tips from friends, social media, or untrustworthy sources. Neglect company fundamentals. Investing in companies without analyzing their financial health, management, and business model. Misunderstand valuation metrics, misinterpreting metrics like PE ratio, or failing to grasp the significance of a company's earnings growth. 2. Chasing trends and FOMO, fear of missing out. Novice investors often chase hot stocks or sectors that are trending without considering if the valuations are justified. For example, buying into a stock during a market rally, only to see it drop later when the hype fades. Investing in speculative or highly volatile stocks without understanding the risks. 3. Overtrading and high transaction costs. Inexperienced investors might engage in frequent buying and selling due to impatience or an attempt to time the market. This leads to high brokerage fees. Accumulated costs eat into profits or amplify losses. Emotional exhaustion. Overtrading often results in poor decision-making under pressure. 4. Emotional decision-making. The stock market often triggers emotional responses, especially for beginners. Fear and panic selling. Selling stocks during a market downturn to avoid further losses, only to miss the eventual recovery. Greed and overconfidence. Holding onto stocks too long in hopes of higher returns, or investing large sums into risky assets. 5. Ignoring diversification. Novice investors often concentrate their investments in a single stock, sector, or theme, exposing themselves to higher risks, following a home bias where they only invest in familiar companies, missing out on global opportunities. Diversification helps spread risk, but ignoring it can result in significant losses if the chosen stocks or sectors underperform. 6. Using leverage without understanding risks. Margin trading and leveraged investments magnify both gains and losses. Beginners may misjudge market movements, overestimating their ability to predict stock prices. Face margin calls, losing more than their initial investment due to a lack of understanding about how leverage works. 7. Failure to set realistic goals. New investors may expect quick and unrealistic profits, leading to frustration and impatience, making impulsive decisions when returns don't meet expectations. Chasing high-risk investments, choosing speculative stocks or penny stocks to get rich quick. 8. Neglecting risk management. Beginners often fail to implement risk management strategies, such as stop-loss orders, not setting limits to minimize losses during downturns. Position sizing, investing too much capital in a single stock or trade, increasing vulnerability to losses. 9. Market timing and predicting trends. Many novice investors try to time the market by predicting highs and lows, which is notoriously difficult. This often leads to buying high, selling low. A common mistake when reacting to market emotions rather than data. Missing out on long-term growth, constantly trying to time the market results in missing long-term compounding opportunities. 10. Ignoring macroeconomic factors. Stock prices are influenced by broader economic trends, including interest rates, inflation, and geopolitical events, corporate earnings, and market sentiment. Ignoring these factors can lead to investments that don't align with the prevailing market conditions. 11. Overconfidence. After initial success, a novice who experiences early gains may become overconfident, leading to taking excessive risks. Investing in speculative stocks without due diligence, Ignoring fundamentals, believing that their intuition or luck will continue to pay off. 12. Lack of a long-term strategy. Many beginners focus on short-term gains without a clear investment strategy. This results in frequent portfolio changes, reacting to daily market news without a long-term perspective. Missed opportunities, selling high-quality stocks too soon due to impatience or a lack of trust in long-term growth. 13. Listening to misinformation, relying on unverified advice from unreliable sources like forums, social media influencers, or speculative news outlets. Friends or family members who may lack proper market knowledge. 14. Ignoring tax and other costs. Novice investors may overlook the impact of capital gains tax, eating into profits, especially for short-term trades. Other hidden costs, such as platform fees, subscription services, or penalties for early withdrawals. How to avoid losing money as a beginner. To avoid these pitfalls, novice investors should educate themselves, learn basic financial and market principles. Start small, invest modest amounts initially to gain experience. Diversify, spread investments across different sectors and asset classes. Stay disciplined, stick to a clear strategy and avoid emotional reactions. Use demo accounts, practice trading without risking real money. Consult professionals, seek advice from financial advisors or seasoned investors. By taking these steps, beginners can reduce the chances of losing money and build a solid foundation for successful investing.